technical analysis. So far, we are looking at the logical fundamental ideas that we believe affects the markets. Let us now look at the other branch of market analysis, that is, technical analysis. A study of price charts, volume of shares traded, and several derivatives of price and volume that we call indicators. Do you use any of these to aid your trading decisions? A stochastic oscillator, RSI, MACD, Bollinger Bands? Do you really know what they actually indicate? Do you know how they are calculated? Do you know when they are to be used and when they are to be ignored? I am confident most of the normal traders like you simply use these indicators because you have heard about them or because they are provided free in your charting software and never made an in-depth study of how they are to be used. You have only curiously glanced and picked up a couple of ideas and started applying them without knowing them perfectly. Not knowing and studying them in detail, we tend to lose our hard-earned money and come to a conclusion that these indicators do not work. It is akin to using a pen like a knife and then complaining that it does not work effectively. Almost all indicators will show you the right direction to trade when they are used in the manner they are designed for. Gaps. Most traders have heard of gaps, and we hear the words, "Markets opened with a gap today," indicating either bullishness or bearishness in the markets. We then form our own opinions without even understanding the importance of irrelevance of the gaps. There is one more erroneous view among the traders that the gaps are filled, when the true fact remains that not all gaps are filled, and there is a lot to learn about gaps. A simple question I would like to ask you, the reader, here. How many kinds of gaps are there? Surprised? No, the answer is not gap up and gap down. Think about this. You have never asked this question. Until you know the real answer, you really do not have the understanding to trade the market using gaps. To answer, there are 4 kinds of gaps: common gap, continuation gap, breakaway gap, exhaustion gap. This brings about the next question. How do we identify them? How do we trade them? How do we know which gap will be filled? Let us understand them. Common gap has no practical view. It appears in a trading range. Continuation gap typically is the midpoint of a developing trend. Breakaway gap. This indicates that a new trend is beginning and appears when markets move away from a trading range. Exhaustion gap. This gap is typically the third gap in a series of gaps when the market is trending. This is the only gap that gets filled quickly. Thus, you should note that only one among the 4 kinds of gaps gets filled. Any trader who is trading every gap to be filled would only be successful 25% of the time. Surely not a good trading strategy without a complete knowledge of the theory.